Hello, everybody. So we are starting towards the end of chapter 10. I know I didn't number your pages, but it's the page numbered 3 at the top. And it says demonstrate how to report and analyze property, plant, equipment, and natural resources. And what we're looking at is what companies should disclose if material. The first one is depreciation expense for the period, balances of major classes of depreciable assets, by nature and function. You know what? I want to update this for you, Emily. They changed the book over the summer, even though it's the same version. It's super irritating. But because it's electronic, they can do that. Sorry, that's right at the bottom there for you. Now I had to make some changes to it. So if the one you open wouldn't be the same, my apologies. All right, number 3, accumulated depreciation. Either by major classes of depreciable assets or in total. A general message, general description of the method or methods used in computing depreciation for the major classes. I'll give you guys a minute to write that, catch up. Okay, now we're looking at what is covered in the analysis section. And the first one is asset turnover. And asset turnover, the formula is net sales divided by average total assets. And remember, average total assets equals beginning of year assets plus end of year divided by 2. And I said year there, really should write period, but I think it's going to run me long because you can do it on a monthly basis or a quarterly basis as well. Sorry about that. And then you have profit margin on sales. And so this would be net income divided by net sales. And our return on assets equals the 2 multiplied together, asset turnover times profit margin. And so you can see when we just line them up with their formulas, asset turnover times profit, you get net sales over average total assets multiplied by net income over net sales. So we can cancel out the net sales, and it's also equal to net income divided by average total assets. So what do these tell you? The first one the first one gives you asset turnover, and it's basically how well you're using your assets to produce sales. Profit margin on sales is similar to gross profit, but what we're doing is taking all of our expenses down to the bottom line and taking net income. And then return on assets is, of course, hopefully something that you've seen, and it gives you how much profit you're earning on your assets. Okay, so take a try and practice 4. Okay, so our formula here for asset turnover equals your net sales divided by your average total assets. And so that equals 1 million divided by 900,000 plus 1.1 million divided by 2. And so you end up with 1 million divided by 1 million. Anything divided by itself is, of course, 1. So the answer is D, 1.0 times. Okay, let's try number 5, unless there's any question. I'll give you a couple minutes and you can do that one. Okay, fortunately, these are pretty straightforward here. If you want to use the shortcut, you just take net income and divide it by average total assets. And so 200,000 divided by 1 million. And that equals 0.2, or multiply by 100 to get 20.2%, or 20%, I'm sorry. Any questions? Okay, so now we'll move on to chapter 11, and you guys have that handout. I'll upload. I uploaded number 13, so you're good with that. And we've got 5 practice questions. And so you can take about 5 minutes to do those, and we'll go over them. Okay, let's go ahead and go through these. Costs incurred internally to create intangibles. So that is things like employee costs, overhead, all those things that are internally to the company. And so even though a company can have expenses for costs to create intangibles, they have to pay them out of the company in order to do that. So for costs incurred internally, they are expensed as incurred. Which intangible assets are amortized? So you have limited life and indefinite life. And the answer here is B. Since they are limited life, you can amortize them over that life. But something with an indefinite life cannot be amortized, but should be checked for impairment. When a company develops a trademark, the cost directly related to securing it should be capitalized. Which of the following costs associated with trademark would not be capitalized? And so this is C, research and development costs. Goodwill may be recorded when it is identified within a company. So that is not correct. You cannot internally generate goodwill. When one company acquires another in a business combination. That is correct. And the last one, a loss on impairment of an intangible asset is the difference between the assets carrying amount and the expected future net cash flows. Carrying amount and its fair value is our answer here. The fair value and expected future net cash flows and book value and its fair value are not correct. So we have B. Okay, so what are intangibles? And they're long-lived, that are not tangible. And we'll talk about the types in a minute, the way they've kind of rearranged this chapter. It's kind of odd the way they did it versus the way they did it with other chapters. They don't keep that same alignment. So we'll just get kind of a basic description of them to start. But copyrights, trademarks, patents, royalty agreements, legal licenses, those are the types of things that we'll see as intangible assets. Intangible assets can be broken into two categories. One is a limited life intangible. And these have a limited useful life where they generate revenue for the company. These intangibles are amortized over the useful life. And we'll use the straight line method for our text and for our work. So what are some factors in determining the useful life? The expected use of that asset by the company, the expected useful life of similar assets, any legal, regulatory, or contractual provisions that address useful life. So I'll give you an example of that. I don't know what a patent lasts now, 7 or 15 years, but I know with certain medicines, the government says, you're going to get paid, but you've got to release that out. And so that patent is no longer the same as what it was for some medical things. So that would be an example where the legal life might be shortened due to regulatory work. The effects of obsolescence, demand, and competition. And the level of maintenance required to obtain future cash flows. And then the other category is indefinite. Just looked at what life intangibles. These assets are expected to produce cash flows in perpetuity. These assets are not amortized. Okay. And now, just a reminder, expense most or almost all costs related to internal production of intangible assets. Capitalize into the cost of the asset the external costs necessary to obtain the intangible. Those can be consulting fees, engineering fees, those types of things, attorney's fees, legal fees. Those would be like filing with the court and attorney. Unreimbursed costs to successfully defend the patent, or let's call it the intangible. And if purchased, add purchase costs. Okay. Yes, sir. Give me 1 second. I don't know what I did here. Yep, no problem. Wait. All right. So now I'm going to move down kind of the second partially blank page and says discuss the accounting for various types of intangible assets and financial presentation for various types of intangible assets. Intangible tangible assets are reported on the balance sheet net of amortization. Since amortization reduces the asset, there is no accumulated amortization. Since the amortization reduces the asset directly, there is no accumulated amortization visible on the financial statements, though some companies will report the accumulated amortization in the notes or on the face, like. And then what they'll say is something like intangible assets net of 1.5 million amortization. Tangible assets are generally listed as non-current. And the text assigns intangibles into 5 major categories. First category would be marketing related. Second one would be customer related. The third would be artistic related. Fourth would be contract related. And the last would be technology related. And I included an example from your text or an illustration that talks about the types for those specific and the accounting for them. So it's a nice little helpful guide. Once we're done, we'll jump to example 1 and I'll walk you through that. Okay, so the first one says, identify the typical costs included in the cash purchase of an intangible asset. So when you're purchasing it, you would just purchase it. So there's no typical cost other than that. But when you're creating one, we include the purchase price. Sorry, did that a little backwards. So for A, it's just the purchase price and any legal fees to change. And then when creating an asset, you have legal fees and filing. Part B says, discuss how to determine the cost of an intangible asset acquired in a non-cash transaction. And so you record the intangible at the fair market value of whichever is more easily determinable. The asset given up or the intangible received. Part C says, describe how to determine the cost of several intangible assets acquired in a basket purchase. Provide a numerical example involving intangibles being acquired for the total acquisition cost of $90,000. So what I've done here is created a little table, and it's got the fair value of assets is 100,000. The fair value of assets would be 90,000, and the fair value of the assets would be 80,000. And you paid 90,000 for the assets. And so we looked and said, okay, and I just had to make this problem up, as you can see from the directions. So I just put in, okay, patents are 20%, trademarks are 25%, and copyrights are 50%. And then we wouldn't have goodwill right away. We can talk a little bit about that, but we'll throw it in here for now. All right, so what we do is take 20% and we would multiply it by 90,000. And that gives us 18,000. 25% times 90,000. Check my math on this one. $22,500. And the copyright, 55% times 90,000. And that equals 49,500. Goodwill does not apply in this case. And we have a gain of 10,000. Okay, if the fair value equaled 90,000, you would have just this same thing, except for you'd have no gain and no goodwill. Now, when the fair value is less, take the 20%, multiply it by 80,000. And so that's 16,000. 25% times 80,000 equals 20,000. And then 55% times 80,000 equals 44,000. Little note here, and we'll talk more about this later, but don't record goodwill unless part of a purchase. Of a company or part of a company. All right, so let's look at example number 2. Alonzo Company acquires 3 patents from Shack Corp for a total of 280,000. The patents were carried on Shack's book as follows, and we don't really care. We care about what we paid for them and what our future consideration is going to be. When Alonzo acquired the patents, their fair values were 20,000, 240,000, and 60,000. So we have fair value equals 280,000. Oh no, sorry. 20,000 plus 240,000 plus 60,000, which equals 320,000. So we want to find the fair value percentage of patent BB, which equals 240,000 divided by the total 320,000, which equals 0.75 or 75%. You multiply the percentage by what was paid. So we have 0.75 times 280,000. And so the answer is 210,000. Any questions there? Yes. Acquires the 3 patents from Shack for a total of 280,000. Okay, let's take a look at example 3. Okay, so we have a company has a patent with a carrying amount of 252,000 and a remaining useful life of 7 years. And that's at the start of 2021. During 2021, Snyder brought a patent infringement suit against a competitor. And on October 1, Snyder received the good news that the patent was valid against the competitor, could not use the process Snyder had patented. The company incurred $90,000 to defend the patent. Compute the carrying amount of the patent that would be reported on December 31, 2021 balance sheet, assuming monthly amortization of carrying value of the patents. So on 1/1/21, carrying value equal 252,000. Straight line amortization over 7 years. So we have 252,000 divided by 7, and that equals 36,000 per year. And then we have the addition on 10/1. We're allowed to capitalize fees or the cost to defend the patent. So we have 90,000. And we know that we went through 9 months on 7 years. So it's 6 years and 3 months, which equals 90,000 divided by 75 months, which equals 1,200 per month. So we take full year amortization, 36,000. We add 3 multiplied by 1,200 for the 90,000, and we end up with 39,600. So I haven't done any entries for you, and the entries are not required, but I just want to show you some entries. And so for the purchase, they would record patent for 252,000, cash 252,000. And then they were able, for the legal fees, to capitalize it to the patent for 90,000. Probably cash. And for annual amortization, you have amortization expense, 39,600, sorry. And patent, 39,600. And so the carrying value or book value at year end equals the 252 plus the 90 minus 39,600. And that equals 302,400. You got practice one there. After this, obviously I'll leave this up for you, but you can just take a few minutes and go through that, and we'll talk about which ones are intangible assets and which ones are not. As I come around, if you have any questions on the notes or anything, please ask. Otherwise, you're working on practice one.
Is it for both of these or is it just for this?
For both of them. They're just intangibles in general. Thank you for letting me know. I'll go back up and make sure I correct that because that's a good question. So when I put that reminder in, I put it in under the indefinite life intangible assets, which it should be noted that it's for all types of intangibles. Okay, so Section of accounts found in the general ledger Marshall Corporation. This should be hopefully easy for you. Accounts receivable, right? Not intangible. Goodwill, intangible. Organization costs are not intangible. Prepaid insurance, not intangible. Radio broadcasting rights is intangible. Premium on bonds payable is not intangible. Trade names are intangible. Research and development costs, where IFRS is used, are allowed to be capitalized, but in the United States, they are expensed. Internet domain names are an intangible asset. Initial operating loss. This is not an intangible asset. A non-competition agreement, which hopefully we see go away soon or be better compensated, is an intangible asset. Customer lists are an intangible asset, and video copyrights. Those are your intangible assets. Okay. And then you guys have practice number 2. This one's a little bit longer, so I'll give you about 3 minutes, or if you need it. And if you don't know where to start, you can just ask me or you can talk to each other. Good to go? Anybody need another minute? Okay, so it says, and the hard part here is to look and say, okay, the patent was valid for 15 years, but it was estimated to only have a useful life of 10 years. So you have to take the patent cost, 960,000, and you have to divide that by 10 years useful life. And that equals 96,000 amortization per year. We had 5 years expire. So 5 times 96,000 equals 480,000, or you could just have done half of the life. And so 960,000 minus 480,000 equals a carrying value of 480,000. However, the asset is impaired to 0 value. So all 480,000 would be expensed. And before I jump to number 3, and I don't know if I gave you guys, definitely didn't give you guys any room to put this in. So let's, just a little reminder, you can write it wherever. Because I don't talk much about impairment. So for impairment of intangibles, I'll put together this little table for you so you have it as just kind of a quick study guide. This is kind of a good summary, okay? Depending on how you acquired it, if you purchased it, you capitalize. On an indefinite life, if you purchase it, you capitalize. If it's internally created, you expense or expense, the new fragrance for young people. All right? And then you would expense. And then amortization is over useful life. And then you do not amortize. And for the impairment test, use the standard 2-step recoverability and then fair value. And for the impairment test, it's a single step. and you just compare it to fair value. And so the tests are both in here. They both come from the last chapter. You know, they're exactly the same. So I did write up a whole bunch of stuff, but I figure you guys don't really need to hear me drone on about that. Since it's 3:40, time flies when you were being tortured. I mean, having fun. So you all are free to go. I appreciate you, and I'll see you on Thursday. Bye, Sonia. Have a good day. I'll talk to you Thursday.